For the past 18 months, financial markets operated under two simple, highly lucrative rules. If you were in legacy equities, you bought mega-cap AI stocks and let them ride. If you were in crypto, you parked your capital in the institutional cash and carry basis trade and collected easy double-digit yields. The noise right now is focused on isolated drops. Tech blogs are panicking over Broadcom's recent guidance, while crypto forums are wondering why Bitcoin's open interest suddenly contracted. The signal, however, is far more profound. We are witnessing a massive synchronized yield migration. In the traditional stock market, Broadcom's fiscal Q2 earnings beat revenue expectations. But its refusal to raise forward AI chip targets sent a shockwave through the semiconductor complex. It triggered a brutal 14% sell-off that dragged down the entire tech sector. At the exact same time in Web3, the historic delta-neutral basis trade has compressed to near the US risk-free rate, causing a violent flush of institutional leverage. The hot money is fleeing hyper-extended AI valuations and dry crypto funding markets simultaneously. But this capital isn't disappearing into cash. It is migrating into organic revenue-generating alternatives. Today, we break down the mechanics of this great capital realignment, locate exactly where the smart money is landing across DeFi and tokenized real-world assets, and map out how you should position your portfolio. My name is Newell. Welcome back to the Signal and Noise podcast. Let's dive in. To understand why equity capital is moving, we have to look closely at the semiconductor sector. Broadcom, trading under ticker AVGO, just dropped a bomb on the market. On paper, their fiscal second quarter numbers looked incredible. Total revenue hit $22.19 billion, up a massive 48% year-on-year. Their custom AI semiconductor division, which supplies bespoke hardware to tech giants like Google, Meta, and OpenAI, grew an astronomical 143%. But in 2026, the market doesn't reward backward-looking success. It punishes lack of forward exceptionalism. Broadcom's forward guidance for fiscal Q3 came in at $29.4 billion. Crucially, management stubbornly maintained its long-term AI revenue forecast instead of raising it. Ahead of the print, AVGO was up over 40% year-to-date, trading at a forward price-to-earnings multiple of 42 times, miles above the sector average of 26. When a stock is priced for absolute perfection, maintaining guidance is treated by algorithms as a functional miss. This wasn't just an isolated Broadcom issue. It was a systemic realization that the capital expenditures poured into AI infrastructure might be hitting a short-term plateau. We are now seeing an institutional exit from hyper-extended AI equities. Wealth managers are rotating billions out of high-beta tech and moving it straight into dividend-paying cyclicals, healthcare, financials, and, interestingly, tokenized financial instruments that yield real, predictable cash flows. Now let's pivot to the crypto side of the equation, where a parallel macro shift is happening. For the past year, institutional funds use the launch of spot Bitcoin ETFs to execute the ultimate risk-free arbitrage, the cash and carry basis trade. Funds would buy spot Bitcoin via ETFs and simultaneously short the equivalent dollar amount in the futures market. Because retail demand for leverage was sky-high, futures traded at a massive premium to spot. Institutions were easily pocketing a clean, delta-neutral 15% to 20% annualized return. But structural maturity has caught up with the market in 2026. As institutional capital flooded the trade, the futures premium compressed violently. The basis yield has drifted down to the 5% to 6% range, right on top of the yield offered by a standard US Treasury bill. When a delta-neutral crypto trade yields the exact same return as risk-free government debt, institutional money managers unwind the position. Over the past 2 weeks, we've seen a multi-billion-dollar contraction in futures open interest. This leverage flush has kept Bitcoin's price in a compressed volatility range. The macro money that entered crypto through ETFs isn't leaving the asset class entirely, but it is refusing to sit in low-yielding derivatives. It is actively looking for high-fidelity, on-chain alternatives that can beat the sovereign benchmark. So, where is this dual ocean of capital migrating? It is landing squarely in two highly sophisticated sectors: on-chain yield-bearing collateral and organic revenue DeFi protocols. Real-world asset tokenization has crossed $32 billion in on-chain value. The ultimate example of this migration is BlackRock's BUIDL fund. In a landmark operational integration, major players like Standard Chartered, OKX, and BlackRock launched a framework allowing the BUIDL fund to be posted directly as live trading collateral. Think about the macro power of this move. Previously, margin capital posted on an exchange sat completely idle. Now institutional capital can sit in custody, earn steady U.S. Treasury yield from the tokenized fund, and simultaneously back active trading positions. Idle capital has been completely eradicated. On the Web3 native side, money is fleeing inflationary, vibe-coded farming tokens and concentrating entirely around protocols with real product market fit and organic fee generation. Decentralized perpetual exchanges, most notably Hyperliquid, are capturing massive inflows. Because they generate millions in organic fee revenue from actual trading volume rather than synthetic token emissions, their underlying asset structures are being repriced away from speculation and toward durable value. If you are managing an active portfolio, you cannot navigate the second half of 2026 using 2024 tactics. Here is your strategic playbook for the yield migration. If you are holding second and third tier semiconductor or AI infrastructure stocks trading at trailing PE ratios over 50, recognize that the institutional allocation rotation has begun. De-risk out of speculative tech names and look for cash flow positive asset-backed alternatives. If your crypto yield strategy relies entirely on centralized funding rate arbitrage, your edge has been structurally compressed by Wall Street's algorithms. Move up the risk curve into programmable on-chain collateral. Look at tokenized credit and treasury wrappers that offer composability across decentralized finance platforms. Prioritize Web3 protocols that feature a verifiable, positive price-to-fee ratio. If a protocol cannot prove it is earning organic revenues from users outside of its own token ecosystem, it will be aggressively punished as this capital migration accelerates. Let's bring it all home. The noise. The tech sector is breaking down because of a single semiconductor earnings report, and crypto is losing its luster as futures open interest drops. The signal. We are in the middle of a massive structural rebalancing. Institutional money is realizing that infinite AI valuation expansion requires a reality check, and easy crypto arbitrage has been completely priced out. The capital isn't leaving the ecosystem. It is maturing. It is demanding real yield, structural utility, and programmatic collateral layers. The migration has started, and the liquidity is flowing to the builders of hard financial infrastructure. Position yourself where the capital is landing, not where it's fleeing. Stay sharp, stay focused. That's it for this edition of the Signal and Noisin podcast. My name is Newell. Track the flows, protect your yield, and we'll see you on the next block.